The 30-year Treasury yield just hit the highest level since 2007. And if you're thinking, cool, who cares? Well, you're not alone. Because Treasury yields sound like the kind of thing that only matters to men in Patagonia vest who drink $8 iced lattes and talk about risk-adjusted returns. But the reality is hidden inside that number is the price of money. Because that single number helps determine the borrowing cost on trillions of dollars. And for the first time since 2007, it's flashing a signal we haven't seen in nearly 2 decades. But the real story isn't just the headline. It's the damage that number is quietly causing underneath the surface. And that damage is starting to surface in a $2 trillion asset class. Even as interest rates are rising at the fastest pace in history, many players are still selling the idea that everything is under control. But the reality is, those two things can't coexist. And that's what makes this so interesting, because this story has only just begun. The hush-hush surrounding all this is by design. But to understand what's happening, we need to back up to that one number from earlier. Because when the 30-year Treasury spiked to over 5%, the United States had company. The UK's 30-year just climbed to its highest level since 1998. Germany's 30-year reached its highest since 2011. And Japan's 30-year is now sitting at an all-time high. This is a global phenomenon. When 4 of the largest bond markets do their best impression of Dogecoin after a tweet, it raises a question. What is happening? The bond market's supposed to be boring, predictable, and something your grandpa falls asleep watching. It's labeled as the adult in the room. But while everyone's distracted by AI hype, the adult in the room quietly just pulled the plug on the party. Let's explain bond yields. A bond is just an IOU. The government or a company promises to pay back a fixed amount at a maturity date. The relationship between a bond's price and its yield are inversely related. If the price goes up, the yield falls. Price down, yield up. When yields rise, buyers demand a higher return. This happens for 4 reasons: the Fed, inflation, supply of debt, and demand from institutions. Each maturity tells a story. The 2-year reflects the Fed. The 10-year is the global benchmark. The 30-year asks, do you trust U.S. fiscal policy? But the scariest part isn't the long end, it's the short end, where the Fed has their little greasy fingerprints all over. Quick pause. The average American takes in 100,000 words daily. Imagine that now. This brings us to today's sponsor, Plod. With the Plod Note Pro, you can transcribe calls and notes into clear summaries. It's multimodal, adding text and images for full context. Stop losing track of ideas. Try Plod using the link below with a 30-day money-back guarantee. Now, back to the rate causing panic. SOFR. SOFR is the overnight receipt for the entire U.S. financial system. In 2022, it was 0. By mid-2023, it was over 5%. When rates rise this aggressively, there's consequences, especially for floating rate debt, which is tied directly to benchmarks like SOFR. This leads us to private credit. These are loans for companies too large for small banks, but too complex for Wall Street public bonds. In 2021, Pluralsight was acquired with over $1 billion in floating rate loans. When SOFR hit 5%, they were underwater. Jamie Dimon said, "When you see one cockroach, there are probably more." The private credit default rate just hit 6%. How can record defaults happen while the industry acts like things are good? The answer is sneaky accounting called PIK, payment in kind. PIK lets a borrower pay interest with more debt instead of cash. Technically, no payments are missed, so the loan looks healthy. Funds then report this unpaid interest as income and pay out cash dividends to investors on money they never actually collected. A tidal wave is building, the private credit maturity wall. $85 billion in loans coming due between 2026 and 2029. You can hide a loss in an accounting line, but the math is still the math. And bad math doesn't just disappear. Subscribe for more.